Over the past 2 months, software stocks have really taken it on the chin, and none more so than the original software as a service stock, Salesforce.com. Well, the company reported earnings after the market closed today, and there were some big announcements in there that we're going to get to, but it seems like they weren't all that pleased with what they heard, sending shares down by as much as 5%. So what does this mean for shareholders moving forward? My name is Brian Stoffel. We'll spend the next couple of minutes trying to figure that out. I want to give a shout out to Fiscal AI for sponsoring today's video. And before we get in, just a quick primer. Some people may have seen that I did a video with Brian Feroldi a little over a month ago, and afterwards I did buy a position in Salesforce. However, it was incredibly poorly timed. It was before any of the releases from Claude came. And once they did start dropping, I spent much more time thinking through the dynamics of switching costs. And after I did that, I decided to sell those shares. So I want to get that out there for all to see. I've made other videos about switching costs as it relates to businesses like Salesforce. But with that out of the way, let's look at the company's fourth quarter of fiscal 2026. They have an odd calendar. So revenue grew 12%. That beat analyst estimates. It beat management's own guidance. So top line, looking good, 12% growth. Bottom line, earnings per share exploded, more than doubled. The company is clearly focused on squeezing out productivity, up 118%, and beat both analyst estimates and their own. When we look at margins, we ever so slightly saw a contraction in gross margins, a more meaningful contraction in operating margins. However, because of some one-time and tax situations, net margins actually did increase. It's worth pointing out, free cash flow is prodigious, pulling in roughly $5 billion in free cash flow. Net income was up at a much smaller pace. The balance sheet, there is a large portion of debt that is owed over the next 12 months. And if we add that in, it is somewhat upside down. Once that is paid off, it'll be a different picture. But that's worth keeping in mind once you hear about the buyback plan that was announced. But first, I want to go down this balance sheet to talk about what was happening. So as we said, revenue was up 12%, but the cost of that revenue was actually up 13%. That's why I coded it red. Now, if we look at this, there's two different types of revenue. There is professional services, which is basically helping businesses to set up Salesforce on their premise. And as you can see, Salesforce gives this away for free. They have negative gross margins. They pay those service professionals more than they receive from the companies who use them. They actually got worse during the year, but what's much more important are the gross margins, which are incredibly high for the subscription services. They did contract ever so slightly, but still above 80%, looking healthy. In fact, it was such a small amount that even though the cost of revenues increased faster than revenue, in the end, the gross profit was still at roughly 12%, the same as revenue. However, all the expenses really come in when we talk about operating expenses. And this is on a GAAP basis. Salesforce has very, very high stock-based compensation. So what you see here is that operating expenses increased 15%. That is faster than the revenue. So even though it was just 3 percentage points faster, because operating expenses, not the cost of revenue, but operating expenses are the key form of the company using their capital, income from operations was only up 3%. Now, there was some other stuff that happened to get the net income that we did, but it is worth pointing out that while they do have copious amounts of stock-based compensation, they also have a major buyback program, and the number of shares outstanding actually decreased 3.5%. Now, one other major announcement that the company made that is worth noting is that their board of directors approved a new buyback plan which supersedes all previous buyback plans that hadn't yet been fulfilled for $50 billion. Yes, that's with a B, $50 billion share buyback program. We're talking about a company that is roughly $180 billion today. So if you just do some very simple math, a $50 billion share repurchase program would be, if it was executed all at once, which it cannot be, to be clear, that would eliminate 28% of shares outstanding. So they're sending a signal. Whether or not that reeks of desperation or is a really smart capital allocation plan, I'll leave up to you. But there's more going on underneath the hood. And for that, we're going to turn to Fiscal AI, which is the best resource for individual investors out there. If you'd like to use it, which you're going to see me do in just a second, simply click the top link in the show notes below. So the first thing I want to do here is I've pulled up on Fiscal AI the revenue growth rates for Salesforce, because you can see that they were decelerating until this summer when they had a nice little re-acceleration. And a lot of people, especially on social media, were pointing out, hey, look at this. We just went from an 8.6% revenue growth rate to a serious re-acceleration, a growth rate that we have not seen for quite some time, 12% growth. Not so fast. The fact of the matter is the company closed on an acquisition of Informatica during the quarter, and if we back out the revenue that Informatica contributed to the company's revenue for the quarter, the revenue growth rate actually would have decelerated, which isn't a death knell, but it would have been 8.1%. So this would have continued in a downward fashion. Again, not a huge problem, but worth pointing out that this is a mirage. Now, what else was going on? Well, what I've done here is I've pulled up all the different revenue streams that Salesforce had. Now, Salesforce also said that they may discontinue breaking out the revenue streams this way. They haven't made a final decision on that yet. So the first is their legacy sales CRM business. And then we've got their service revenue. So companies use it for their service departments. After that, we've got platform and other revenue, which includes things like Slack. After that, we've got integration and analytics, and finally, marketing and commerce revenue. And it's worth looking at where are the growth rates of all these, especially the most important ones. So if we look at the sales, the top one right here, the sales, there was solid growth during the quarter of 9%. That looks pretty good, all things being equal. If we look at the service revenue, that's the purple right there. Again, we see the revenue growth rate staying fairly healthy at 8.8%. So far, so good. If we look at platform and other, right here, we see a huge acceleration from 20% all the way up to almost 40%. But again, this is where that Informatica acquisition comes in. So we shouldn't get too excited about that. That being said, the numbers still look healthy. If we look at integration and analytics, on that, we're starting to see some fairly serious weakness starting to show up. And so this is starting to lag on the company's results. And it's not nothing. It's nowhere near as big as the other three we've already covered, but it is about $1.8 billion in revenue. And finally, marketing and commerce. Sorry, I clicked on the wrong one there. Marketing and commerce. This is also not doing very well. Its revenue growth rate is all the way down to the single digits. So that has been a drag as well. So those are the different lines of business that Salesforce has. One other thing that's really important to call out is remaining performance obligations. So this is like the pipeline for future revenue. And remaining performance obligations at the end of the quarter were at $72.4 billion, coming in at 14.2% growth. However, it's worth pointing out that about 4% of that growth came from Informatica. So actually, it would have been at closer to roughly 10% growth, a deceleration of the growth rate. That being said, again, that deceleration is not a huge problem, but it's worth making sure that we're trying to compare apples to apples while we do this. Now, here's another part that's really important because it came up during the conference call. Current remaining performance obligations. In other words, RPO can include things like contracts that are 1 year, 3 year, 5 years into the future. Current just means of the revenue that you're contractually almost guaranteed to get and recognize over the next 12 months, what was the growth there? And the fact of the matter is, on a constant currency basis and an organic basis, so we don't include Informatica, that was just 9% growth. And that's going to be important to remember because that, while it was faster than the organic revenue growth of 8%, it was not what a lot of investors were hoping for. And the first question on the conference call had to do with that. Because what you're going to hear a lot is Agentforce. And let me just explain what's going on here. Salesforce is a seat-based, primarily a seat-based system. So the more people that you have signed up to use the Salesforce CRM, then the more money that Salesforce is going to get. The problem with that is in the age of agentic AI, you can have one human doing the work of 10 humans a few years ago. And so you need a usage-based alternative in order to really capture all of the growth that could happen moving forward. Now, what Salesforce does is they talk about this usage-based option, Agentforce, a bunch. And listen to these numbers. Agentforce during the quarter grew 169% year over year, ending with $800 million in annual recurring revenue. Now that sounds really good, right? Well, here's the problem. We're talking about a company that just did $40 billion, closer to $42 billion in revenue. 800 million at an ARR, 800 million is less than, it's around 2% of ARR. So even though it's growing very fast, the fact of the matter is it needs to grow fast enough to make up for any loss of seats. Now, management did say on the conference call, they said, and I quote, "Our seats, we're still seeing them grow quarter over quarter," which is good news because if seats are growing while Agentforce is doing well, then that's good news. Here's the problem with that. If you need to tell investors on your conference call that seats are growing, that does not bode well looking out over many years. And it really lets you know that what needs to happen is Agentforce really needs to start growing fast in order for the math of the valuation of this to work. Now, let's look at guidance. Management gave guidance for the full year of midpoint of $46 billion, which was pretty much right in line with what Wall Street was hoping for, and earnings guidance, which was pretty much right in line with what Wall Street was hoping for. It's also worth noting that they updated their revenue guidance for fiscal 2030. They moved it from $60 billion to $63 billion, which again sounds very bullish. But it's worth noting that that $3 billion bump can probably almost entirely be accounted for through the acquisition of Informatica, so it really doesn't mean a whole lot. Now, if I were still an investor in Salesforce, what would I be looking at moving forward? Number one, current RPO. I want to see that number accelerating and growing meaningfully faster than revenue, because that shows me that there is this balance taking place between not losing seats, or if I am losing seats, I'm accelerating Agentforce so much. There's so much usage-based revenue coming in that I'm going to be able to bridge the gap and transition this business model that I have, which is why the second thing I would watch is Agentforce growth. Third, I would keep an eye on guidance because, look, this is the type of issue where I don't think existing customers are going to pull Salesforce out. I do think that they are going to use Salesforce and their Agentforce for growing as a company. That's not where the problem is. The problem is potential new customers coming on board and whether or not they'll do that. And that takes more time to show up, which is why guidance is important. And finally, I would definitely keep an eye on gross margins because if Agentforce accelerates, we need to know what does the gross margin profile look like for usage-based revenue as opposed to seat-based revenue. We have to wait and see. All of this is why I say the moat direction is uncertain right now, and so is the investment thesis, which is why I don't own shares. Now, look, I will not beat around the bush. When it comes to kind of this SaaS meltdown, I've been caught in it just along with everyone else, and I want to be transparent about that because my portfolio has fallen. It is still beating the S&P 500 ever since the end of 2014. It is still beating the NASDAQ composite, albeit by a smaller margin ever since then. And we are spending all of our time within my community, Stock Investing Mentor, figuring out what to make of all of this. If you'd like some guidance in what to do with that, you should consider joining. Stock Investing Mentor has 3 parts. One is 1 hour of live instruction every week, Thursday noon Eastern, that is recorded. 2, full access to my real-life portfolio as well as a video description of any moves that I make within that portfolio. And 3, 24/7 access to a private online investing community. But the big question that still remains is what about the valuation of Salesforce? Because look, if we head back on over to Fiscal AI, there are some numbers that make Salesforce look awfully cheap, like the fact that it's trading at now 24 times trailing earnings. And you know, that might not sound mouth-watering, but consider that over the last couple of years, the average PE that Salesforce has been 73. Or what if we look at the company's price to free cash flow, which is going to be even lower because of all the stock-based compensation, currently trading at just about 13 times price to free cash flow. That's one way to look at it. But I do think that if we do a reverse discounted cash flow analysis, that might give us a better idea of what's going on. So for this, let's just take a look at the trends when it comes to the company's free cash flow margins. So to do that, what I'm going to do here is I'm going to go to ratios, and what I want to go to is margins. And when we do, we're going to look at free cash flow margins. And we're going to try and figure out where are they headed, where should we assume that they will be. And what we can see right here is that free cash flow margins are currently at about 32%. Now let's just assume that we need to pull that back a little bit because maybe the gross margin profile of usage-based revenue is different. Now, if that's the case, let's just give the company a 30% free cash flow margin as an optimized free cash flow margin. And if we do that off of a base of $41.5 billion, that would give Salesforce $12.4 billion in free cash flow. So if we give Salesforce $12.4 billion in free cash flow, and we say that's our optimized growth number, then how fast does Salesforce need to grow per year to justify today's stock price? Well, if we give them a 2% terminal growth rate and a 10% discount rate, well, then it's not that bad. And remember, shares are trading for about $180 right now. So, I mean, this comes down to about 3%. About 3%. Here's the thing. If the company only needs to grow at about 3% in order to justify it, well, then you need to bring this terminal growth rate down to about 1%. So if you do that, then we're saying that it needs to grow at about 4%. Does that seem reasonable to say that Salesforce could grow at about 4%? We could look and see what analysts are estimating. They believe that, for what it's worth, if the company hits their goals of $63 billion, then that will mean that they have grown at 11% per year over the next 4 years, which would make Salesforce wildly, wildly undervalued right now. A great deal. At the same time, it's worth noting that analysts over the last few years have consistently been downgrading their expectations for Salesforce revenue. For instance, when the high point for what they thought 2024 could be was almost $38 billion, but it ended at about 35. If we look at 2024, the high point was at about $39 billion, but they ended at about 38. I mean, look at this year that just ended. They thought it would be at around $43 billion, came in at around 41.5. So there's a lot up in the air here. The bottom line when it comes to Salesforce is that if this company can shift their business model and not only figure out a way to keep their existing customers and become more usage-based and bridge the gap between any seats that they might lose, but also get new customers into their ecosystem against AI native competitors that might be able to offer better prices, well, then it will be incredibly great deal to buy shares today. If they can't do that, then there is no price that will be worth paying. And so it really depends on your own understanding of the industry and those dynamics to decide whether or not these shares are a deal today. Let me know what you thought of Salesforce's earnings in the comment section below. And don't forget to hit subscribe to catch up on Salesforce when they report next in 90 days. Until then, Brian.